Okay, everybody, good morning and welcome to our session today. We call this the quarterly apartment download. 4 times a year, we get on with you guys and just talk about what's going on in the apartment industry. Today, we're going to talk about two topics that we're spending a lot of time on. What's happening in new apartment construction in Canada, and then we want to talk a little bit about where does dry powder go? There's a lot of money sitting on the sidelines today, waiting to invest. We want to talk about why Canadian investors should consider going to the US. Then we're going to do a couple of just things that are going on in our business. So let's get started talking about new apartment construction. I see that I scroll through the list of people here. There's many people from across the country. I happen to be in Alberta today and spending about 10 days here. Very, very interesting market and a very different market than what's happening in Eastern Canada, and so on. So let's just go to the next slide and talk about new apartment construction in Canada. Look, we've had a okay, this is an important slide to show, just summarizing apartment transactions. The blue line is the number of apartment transactions in Canada that are occurring over $3 million on a month-by-month basis. And we're going from January 2021 till the spring of 2023. And you can see that, the transactions in October 2022, January 2022, were the highest was about 92, but there are several months there of, 60, 70, 80 transactions per month. As we've gone into 2022 and 2023, you'll see that transactions have declined. And that is a function of, I think, what's happening in the marketplace with interest rates, where with the spread between the buyer's price and the seller's price is a gap, and there's a bigger gap there than before. So as a result, transactions aren't happening. And clearly you can see that, from highs of 60s, 70s, 80s, 90s, per month, we're in now the, 20 to 30, let's say, in the last year. So we also plotted the average price, and this is the total size of the deal. So a 10, 20, 30, 40, $50 million deal. I'm not sure if I see a complete trend here because, for example, in January 2022, the average size of the transaction was about, $10, $12 million, but there were many more that were occurring. But I would say that I would expect that we will see more smaller deals occurring. Looks like that's been happening in the last 3 months. And that's, again, larger deals are probably more riskier. Most of the institutional guys they're coming back to the marketplace, by the way. They were sitting on their hands for the last 12, 18 months, but certainly from the interest that we're seeing in deals that we have out in the marketplace, there are more people interested, more people touring, more offers, but it's still not the same market as it was in, let's say, 2020, 2021, 2022. Okay. So summarizing here, number of apartment transactions have clearly dropped in the last 12 months. But remember, this has a lead time of probably 6 months from when a transaction goes under contract to when it closes. So you might have to shift everything over 6 months to think about what's happening in the particular time frame versus when it's reported. There's a lag here, and that lag is probably at least 6 months. Okay. We'll every quarter we'll show you this graph, and every month we publish this on my LinkedIn profile, just showing the transactions, the number of transactions that are occurring. Okay, all right, Rod, next slide. So we spend a lot of our time on new apartment construction transactions. We probably brokered about 40 new apartment construction deals, meaning something got built and within a relatively short period of time after it was built, and sometimes during lease up, the building was sold. I just had a little technical problem here. 1 second. Let's pick up from where we were. So there's a lot going on in new apartment construction, and I wanted to sort of summarize as to how developers are thinking. So let's go to the new slide. I think that there are 5 ways of thinking. And maybe I've got too much of an Ontario mindset here because I'm in Alberta today and things are much more positive, and I can talk a little bit about that, as we go through. But when we went out in the apartment business, we went out of the COVID fog, which was a fog for the entire world. But in the real estate business, in the apartment development business, we went into the interest rate fog, right? And we're still in it. So if you're sailing a ship from Halifax to London, England, and you're in a fog and all your instruments fail, which is kind of, what sort of it feels like sometimes, then the logical thing to do maybe is to just stop, put down anchor, and wait for the fog to clear. And I think a number of developers have just paused. Okay, and when I say they're pausing, they're not putting a shovel in the ground. But if you talk to architects, planners, and people related to the pre-development side of the business, they're actually quite busy because people have gone ahead and continued to work on their apartment, but they're not putting a shovel in the ground because penciling out new apartment construction is more complex and difficult and less sure than it was before. So the first thing that some developers have done, is pause. Okay, that's this guy room. Okay, and so a significant number of developers, they're not out of the business, but they are just slowing down the pace at which they're moving. They're getting the entitlement work done and so on. A few years ago, and we sell apartment land, people were saying, bring me a shovel-ready site, I'm ready to go. Today, people don't want a shovel-ready site. They're saying, bring me a piece of raw land that I can, go through the process and create value over the next few years because of the uncertainty. So that's number one, is people are pausing. Number two, there are people who are continuing. These are people who are long-term people in the business. And I think they're thinking this way: if I built a building 40 years ago for $10 million, then that building today is worth $100 million. Okay. And if I build a building today for $10 million, in 40 years, that building is going to be worth $100 million. I think there's not a lot of people that would disagree with that sort of a 10 times number over 40 years. What you're just not sure of is what it's going to be in year 1 and year 2 and year 3. But if you're building for the long term, building for your family, building for your a pension fund, building for your estate, then you're able to, I think some of those people are continuing on building. Construction costs have gone up. Some people tell me that they're going down a little bit, but it's a difficult business to be in today in construction because of delays, staffing, everything that you're hearing about, everything in the economy seems to be, coming true in the apartment sector as well. But there are people who are continuing, and those are people who have a really a long-term vision. If you're in the middle of building an apartment building right now, and let's just say that building is worth $100 million, and it's worth 110 or $120 million or something like that. But if you were to build that same building today, it's going to cost more than $100 million it's going to cost you right now, right? And so there is a replacement cost number outside of cap rate, outside of IRR, that I think people are looking at, saying, yes, I can build it for this price today and sell it for this price, but I can't build it for $100 million anymore. So I think that there's a belief that replacement price always catches up with market price at some point. You don't know, it's take 1, 2, 3, 4, or 5 years, but there's intrinsic value in an apartment building, and therefore they are continuing to build because they're building for the long term. Typically, these people who are building for the long term have to be well-heeled financially to get through any tough times that we have. Number 3 is an interesting one, and I was talking to a developer who's a relatively young developer, highly skilled but not that well capitalized, and they're going ahead, they're finishing off a building of which we have recapitalized and brought in a buyer, and they're going ahead and breaking ground on another building. And I said, how are you thinking going ahead and building an apartment? He just said, I believe in the apartment story, right? So what is the apartment story? Well, on the positive side, rents are going up. They are, and everyone who's in the business sees that occurring. And with the low vacancy rate, the shortage of rentals generally, the strong immigration story, I think it's generally believed that apartment rents are going to go up. The only danger to that is legislation. We don't know necessarily what governments will do. In Alberta, there's never been rent controls. It seems like a much more freer, it's a red state. I think of Alberta as a red state if I compare it to the US. I mean, Ontario, we've had a long history of rent controls, and there's always rumblings in the background of when rents go up, of some sort of legislation being brought in to do that. It's a wild card that it's very difficult to plan for. But keep that aside. The apartment story outside of regulation, yes, operating costs are up, construction costs are up, interest rates are up, but the fundamentals of apartments are very strong. Rent growth is expected to be strong. So if you believe in that story, then you can go ahead and build today, believing that interest rates will come down in the next few years. That's the general belief again, and that rents continue to grow, and the replacement value number just keeps getting higher and higher. So that's the apartment story. And some developers are going ahead with that story. Number 4, and I thought this was interesting, we have a client who's typically built, 250 units in per project. And they looked out at the marketplace and said, well, I'm not sure I want to break ground on 250 units, but this is my core business. My children are in the business. I've got a machine that I've got to feed. They just went ahead and they built a smaller building. So instead of building a 250 unit building, they're building an 80-suiter. And typically they don't build buildings of those sizes. It might be a campus of 3 80-unit buildings, but they switched from their high-rise sites, which they've slowed down or paused on, and they moved faster on their smaller sites. And in one case, it's an intensification that they're just building smaller buildings. Sort of makes sense. You didn't want to pause. You did want to continue, but you were a little concerned. You certainly believed in the story, and you want to stay active. And a number of developers have machines that they've built, contractors that they've used, and they want to keep busy. And so it's important to maintain the integrity of your company and to be a merchant apartment builder or a build for hold, but not to let the machine fall apart. And then the last one is maybe more what I've historically seen in the U.S., where you've got merchant apartment builders, and they are not particularly well capitalized. They go out and raise the money. So let's say the equity stack looks something like it's $100 million. The first mortgage might be $75 million. There may be a mezzanine financing for $15 million more expensive. That's going to get you to 90%. And then the developer's last 10% is syndicated, where the developer might put in $2 million. They might raise $8 million. That developer today is struggling to stay in business. If he's a merchant apartment developer, highly leveraged. But that person's thinking maybe, I'm going to build for fees. So there's a construction fee and a development fee here. And I'm going to hope for a promote on the back end, right? And so that person might also go ahead today and do that. And so I wonder if anybody's got a comment or a question on what I just said about the 5 options, or is there a 6th option that we should be talking about? Rod, we are on meetings, right? People are here.
Absolutely. Anybody can unmute themselves and chime in.
Yeah. And we're still live.
We can actually see you, Derek. We're good.
Yeah. No. I'm doing this from my iPhone. Okay. Or if somebody's got a question, maybe pop it in the chat room, because I'd like to hear how developers are thinking. It's interesting that in Alberta, I'm not sure I'm seeing the same. I did about 7 meetings in the last couple of days, and I'm not sure I'm seeing that same sort of slowdown mentality that we're seeing in Eastern Canada. There are a bunch of things about Alberta I think are positive. Certainly the Alberta story is strong in terms of population growth, in terms of income, in terms of the ability of the Alberta renter to pay more than renters in other markets like Vancouver and in Toronto, where they're probably tapped out. And we're seeing a lot of new construction going ahead here, and a pretty strong story. Rod, we've got a seminar coming up. I've forgotten the date now. Maybe you can mention, is it August 9th? Right?
Correct. Yes.
Right. We're going to do a separate webinar on why we think Alberta is one of the stronger markets for apartment development, and we're going to get people from the city of Calgary coming, economic development group, talking about just what's going on in the marketplace. And there's a different story between Calgary and Edmonton, and maybe Edmonton always lacks Calgary, is behind Calgary, and by a year or two. But that could also be an opportunity here in Edmonton, where the Calgary market is improving right now. Edmonton is usually behind it, so maybe the the smart money would also be considering coming to Edmonton as well. So anyway, so those are where we think most developers are. This is all tied to interest rates more than anything else. It has nothing to do with apartment demand. From a rental standpoint, the institutional investors are also sitting on the sidelines because of the interest rate change, and there certainly is a spread between bid and ask between buyer and seller. Okay, Rod, let's go on the next slide. The next thing that we think is kind of interesting is that there's a lot of money sitting on the sidelines, right? And we think it's an opportunity for us as brokers, connectors, fill the gap in the market, is to talk to our private clients typically to bring their money to the U.S. and invest in real estate. And this is not particularly in the multifamily sector. It's in all sectors. And the U.S. market, I mean, population-wise, we're 1/10 of the U.S., let's say, but in terms of transactional volume and just activity, it's not 10 times. There's 100 times difference between Canada and America. It's a very, very different marketplace, much more vibrant. There's something in America called a 1031 rollover, where you can sell your real estate, and if you replace it within a fixed period of time, a year, you can roll that money into another real estate asset and not pay taxes. And you can just keep doing that and defer paying taxes. In Canada, every time you sell a deal, you pay the full tax rate, and then the money you've got left over, you get to reinvest here. That creates a much more vibrant market. And we think, and just America by itself is just much larger and much more diverse. What we realized was that if you're a non-institutional investor, if you're not Canada Pension Plan, if you're not, BCIMC or something like that, and you want to go to America and invest, it's huge, it's confusing, and there's no pathway to make a 10, 20, 30, 40, 50 million dollar investment in America. So we started looking into that and saying, how would Canadian money go to America? Where do you start, right? And so first is, next slide. This is just sort of a historical slide of who are the foreign investors in America. And by far, the largest foreign investor in Canada, in America, is Canada. And that's no surprise. And Canadians have always gone to the US, right? Wealthy Canadians and people looking for diversity go to America. But America is a much larger and a much more diverse marketplace. We had a client who tied up a multifamily building in a major US city, and it looked like a really, really good deal. But when they got into their due diligence and started interviewing property managers, they realized that there was a gang problem in the building, right? And gang problems are very, very difficult to solve. You don't see necessarily gang problems in a building when you tour at 9 or 10 o'clock in the morning. You'll probably see it more in the evening and things like that. So you wouldn't want to be, even although that building looked like a great deal from a cap rate standpoint, on a price per unit basis, on a price per square foot basis, there were some intrinsic problems with the property that someone from the outside wouldn't necessarily see when they did their initial offer. But this stuff like this can come up during due diligence. So it's important to have a good local team and good representation there when you're buying the building. So what I'm saying is that America is too big to just randomly go there. Okay, next slide. So if we talk about the real estate cycle, I'm not sure we know exactly where we are, but we are past the boom, let's say, the overconfidence, and we're probably in the denial, regret, fear, panic part of the market, right? That may be the best time to enter a market here. You're never going to catch the bottom of the market. You only know it when you're past it. But this is a marketplace where cash is king, and we think on the private side that there's a lot of money sitting on the sidelines. I think Canada also lags the US in terms of timing of what's going on, and certainly we lag in terms of lack of transparency and the amount of deal flow. The American market is much more competitive. There's much more data available. There's much more transparency, and I think you can make better decisions quicker in the US market. Although in the Canadian market, because of the lack of deal flow and lack of transparency, if you are in the know, then you can make better decisions. So it's sort of a two-edged sword. But maybe the greatest opportunity for a gain is as we head into the sort of bottom of the marketplace. Nobody knows the bottom, nobody can find the bottom, but a number of people think the bottom is in. A number of people think that there's going to be great problems coming down the road. But if you are ready to start putting some of your dry powder in the marketplace, then we think that looking at the U.S. may be interesting. But how do you start in the U.S. in terms of its size? Where do you go? Okay, a lot of people tend to buy real estate where they have their vacation homes, and that's just because developers, entrepreneurs go on vacation, they're bored, and so one of my clients is a golf course owner here in Ontario, and sure enough, he goes down to Florida, start taking time off and becoming semi-retired, and the first thing he then does is buy a golf course down there, right? And so one way to do it is to think about just where you go, where you're comfortable, where but maybe we thought at a high level, you want to think about the kind of state you're going to invest in. And in America, there's certainly a bifurcation happening with red states and blue states. Doesn't mean a red state is always good or a blue state's always bad. Red meaning Republican, blue meaning Democrats. We assume that most of you on here are conservatives just by nature of your business. But what marketplace is business friendly? What marketplace is tax friendly? And what marketplace is growth friendly? And it's not always just Florida or just Texas. Okay, it could be Indiana or Indianapolis, which is a very strong marketplace. So it's having the information to know which state you should go to, and that comes with having a network of people. And I'm going to talk about that in a minute. So what do you invest in the real estate? Well, there's the normal sort of food groups of multifamily, office, industrial, retail, and hotels. But there's real expertise required when you make acquisitions, and that expertise isn't necessarily available to you if you're a Canadian investor going to the US. I suspect that you're going to probably stay in the asset class that you're comfortable in, right? But it's finding the deal first. It's getting the proper intel on the upside, the valuation, the financing, and then it's getting the team together to do the due diligence, manage the building, and so on. So there's one more asset class news that I find interesting. And Rod, I think in this, sometime in the next 6 months or so, we're going to do a webinar on this concept of build for rent. Okay, single family rental. And this is a picture of this is obviously somewhere in the southern U.S. But imagine a subdivision or something of, let's say, 100 houses that are built, but essentially those 100 houses are used as a rental property. Okay. And this is now becoming more common in the U.S. It doesn't really exist in Canada in any format yet, but it's a collection of single-family homes. They're built to a different spec for a single-family home renter. They can have all the amenities that an apartment building has. In this one here, you can see there's a clubhouse when you first drive in. There's a community swimming pool, but this could be 100 or 200 houses, and those houses are built with the same skill that a home builder needs. And then they are either owned by that owner, like an apartment building, it's a revenue producing asset, or it's sold to someone who buys BFR, SFR as their business, in terms of some kind of a private wealth fund, a syndication, or something like that. It's a very, very interesting business, and I think it's something that could come to Canada. And Canadian investors are investing in the U.S. in BFR, SFR. So it's an additional asset class that you could start looking at. So we've got 7 mandates right now. We expect to have a number of other mandates from our clients who want to go to the U.S. And it really is spending time with them and then the people that we're going to connect them with. And so this is where the network of brokers, financiers, and investors becomes very important. First, it's where do you go? Which asset class do you come in? And then do you have the team to help you buy that? So we spend a lot of time with our client. It's essentially a conversation, right? Why do you want to go to the US? How much money do you want to take there? What's the asset class you feel comfortable in? So we have as an example, a client here that we sold their apartment portfolio. They have they received, hundreds of millions of dollars from the sale of their portfolio. They understand the apartment business very well. They've been in it all their lives, but they no longer want to be active in the business. But so they want to get active returns, but they want to be passive. So they are looking to joint venture with developers in Florida to build apartments, but they want to not be the guy with the hammer in their hand, so to speak, right? And so how do we go about finding a developer or at least a group of developers that will be interested in an investor? And then how do we go about putting that together to get to, some kind of a joint venture structure? That's an example of one of the mandates that we have. Another mandate is from a Canadian client who's already active in the US, doing rehabs of apartment buildings. And they have 3 buildings that they're finishing off that they're going to sell, or they're willing to trade those 3 finished buildings for core type assets that need repositioning. And so they would trade those 3 buildings, they'd rebalance it with cash, one way or the other, and maybe take over 1, 2, 3, 4 assets from someone who has them in 8 cities that they've identified as growth cities, right? And so there's a lot of information in the US available relatively cheaply, so that you can start doing very, very good analysis and comparing, one state to another, one city to another, one neighborhood to another. So it starts with the council client. We'll talk to you, and then we'll put you in touch with one of the people in our network and start talking about finding you deals that make sense for you. So this is the network. We've got, Canadian investors who want to go to the US, and we are part of the SVN Network, which is about 200 offices throughout the US. And you can see the map there showing the blue dots of all the SVN offices. There's another group of people that we have sort of provisional membership with called the Society of Exchange Counselors. And it's a group of about 100 real estate brokerage professionals, companies similar to ours. They've been in the business a long time, and they exchange real estate and they sell real estate. So let me give you an example about how this might work. So we've got a client, the one I mentioned earlier in Florida, who wants to joint venture with a Florida developer to build apartments. They live in Florida 6 months of the year. They're not ready to fully retire, but they don't want to be, have the hammer in their hand. So we get a written mandate from the client, and we stand up in a room at the Society of Exchange Counselors. The last one was in Denver. The next one is in Louisville. We send a team of people down there. We stand up in the room and we say, we have a client, a counseled client, who we closed with already, that's already living in Florida, that has $10 million that they want to invest in Broward County, okay? We've got 99 people like us in the room listening to what we're saying, all seasoned veteran real estate practitioners. And we're gonna stand up, and in 5 minutes, we're gonna tell the story of our client, the relationship we have with them, what they wanna buy, their financial strength, and why they wanna do it, and the timeline. And then we'll have people in the room stand up and say, I'm a taker, I've got someone for you. Or someone would stand up and say, well, it's interesting your client wants to be in Broward County, okay? But you know what? I think Dade County is better. It's the next county over, and here's why. Or they might stand up and say, yeah, we understand you like Florida, but maybe Florida has already been played out. The smart money was there a year or 2 ago. Why don't you come on over to the Florida Panhandle? Why don't you come over to Alabama? Let us tell you the story as to how your client can get what they want, but not necessarily in the box that you put them in. It's an extremely open group of people. They're there to help each other. And then no fees are paid till a transaction occurs, okay? And typically the fee that we get would be what our client pays us, and the other broker who brings the deal in Dade County would get paid by their client. And or someone will just say, no, that strategy is correct, but you need to define it this way. $10 million just isn't enough to get someone's attention. You've got to make it $20 million or something along that lines. The other thing that people here will do is that they will exchange real estate. So, we might stand up and say, look, we've got a client who's got $10 million and wants to invest in a joint venture. And they might say, you know what, we've got a $10 million in Broward County on an apartment building, $10 million second mortgage. Would your client be interested in buying that, right? And then trading that into something and so on. So it's very, very interesting to do. We've been to several meetings now, and we've got a number of irons in the fire with clients of ours. So this can be, you want to invest in the US, or you've got an asset in the US right now that you would like to sell or exchange for another asset, right? And it's not a listing agreement. It's just a mandate that we have to go and vet it through the organization that we're involved in. It's extremely interesting. You know, when I'm sitting in the room hearing about the deals that people do, someone stood up and said, you know, I've got a $5 million piece of land that I want to sell. My client loves the land, but he needs the $5 million somewhere else. So the land's for sale. Somebody stood up and said, you know, I'll buy that land for you for $5 million, but your developer can buy it back from me in within 5 years for $7.5 million. So basically you loan the guy the land, right? That's a simple solution. So he gets his $5 million, he goes, does what he has to do, but anytime in the next 5 years, he can come back and buy that piece of land back from the buyer. And that buyer would be actually quite happy to sell the land because they'll make a $2.5 million profit, but they also have to believe in that land and that it's worth the $5 million they paid for it, because the guy may never come back and buy it. I just think that to do transactions, and we're doing transactions right now in Canada, they are more difficult to do. And a transaction, to get it done today, requires transparency from the seller, transparency from the buyer, and transparency from the broker. You should always have transparency from the broker, but to get deals done today, we are saying to the buyer, what's the yield you need to get to make the deal work? And he says, I need a 6% yield. We'll go back to the seller and say, how can we structure the deal so they get their 6%, right? And if the buyer's an institution, it's a difficult world he's got to go through, going through his credit committee and going through the board. We may put together a seller's offer where we put together a purchase and sale agreement that the seller has signed with terms that can allow the buyer to meet their hurdle rates, and we'll deliver that offer from the seller to the buyer. You see, now why would we do that? Well, in an institution, it's very difficult to get approval to buy something today. But if you take an offer to an institutional acquisition manager, he now gets to say, that offer arrived on my desk, okay? It meets our hurdle rate returns because we've had a discussion with him, but now he gets to take it upstairs without getting approval to bid on it because the offer is there. We did that recently on a piece of land where we took a seller's offer to the buyer, and he accepted it. The deal has gone firm. So I think as brokers today, we've got to think very differently than we have before. But I think buyers and sellers also have to be transparent to get a deal done. If you're interested in this idea of investing in the US, so you're already in the US and you've got an asset that you'd like to buy, sell, exchange, you want to bring money to the US, you're interested in buying mortgages in the US, we're actively involved in all of those through these 200 offices of SVN and through this 100-member of the Society of Exchange Counselors. Dave is on this call. There's his contact information. Rod, maybe you can just pop his email into the chat room, and you could chat with Dave about how we could at least start guiding you and taking you down the road to investing in the US. A couple of little things that we've also got going on. Rod and I wrote this book called The Selffunding House. And maybe I've talked about it before, but something that's very top of mind for both Rod and I. You know, we wrote this book to answer the following question. How does my child afford a house today? Okay. And the answer is, the way they afford a house is to become a landlord, of which most of you are, right? And so we wrote a book that's basically a mind shift book number one, which is written out in the marketplace, and it's on Amazon. And this wasn't, by the way, a for-profit venture for us. This was you know, this is just an interesting idea. Let's just do it and see where it goes. And actually, it's actually gone somewhere now, which I'll talk about in a minute. So we wrote this book called The Selffunding House, which basically says one of the best paths to home ownership for young people today is to buy a house and become a landlord. That means duplex the house, put in a backyard apartment, put in a laneway apartment, can build an apartment over the garage, whatever it is. But that income now allows you to buy your first home, because, you know, if you can get a $1,500 a month in rent from that apartment to put in a basement apartment when you first build a house is probably about $70,000. Okay, so that $70,000 additional cost might allow you to gain a revenue of maybe $1,500 to $1,900 per month. Okay, that far offsets the cost of leveraging a $70,000 build in the basement or for the accessory dwelling unit in the backyard. And it's something that everyone's done. Everyone who's an immigrant knows someone where families shared houses, there were basement apartments, things like that. So it's been going on for a long, long time, but we just want to create the mind shift of younger people today. And it's a tougher gig to own a house, because when some of us older guys bought our houses back in the day, it was, 3 times our income or 4 times our income. Today, it's 10, 15 times your income. So it is harder to buy a house. And one way to make it easier to buy a house is through buying a house, converting it, or getting the developer to convert it. And the second book that we've written is how you actually do it. That's the blueprint for the self-funding house. So physically, how do you go through it? How do you finance it? How do you go through the zoning process? And just the how to build an accessory dwelling unit in your house. Where we've had some interesting traction, and I'm not sure we expected this, but we've gone to some of our developer clients. We haven't gone very public with this yet, other than the book saying this is for how young people buy a house. But developers have said to us, look, we've got some basements half put in. We've got houses that people have walked away from. And so we've got a client who took one of the houses he had that was unsold and put in a basement apartment, went to the city, got permission to build, an accessory dwelling unit. We didn't use the term duplex. Accessory dwelling unit seems to be more politically saleable. And they built the house. We had a number of brokers through it, and we did focus groups on it. Rod ran all of this. And we put together a program to help developers build duplexes. And we're not talking about building a duplex farm of 100 of them like BFR, SFR I talked about earlier. We're talking about just, instead of a developer selling a house, he now sells a properly designed, fully to code legal duplex. But we, and the business is really selling it to homeowners. And sometimes we find the homeowner saying, no, young person's buying, a young couple's buying, saying, no, we'll live in the smaller unit in the basement or at the side or in the backyard. We'll rent out the bigger unit. And that's the only way we can afford a house. And maybe in time that will switch positions. So for home builders, we had a client built a prototype house, and he built it and sold it. We got great feedback from the brokerage community. They're now creating a client base that they haven't had before, and of people who just couldn't afford a house. And now we've brought the price of affordability down. It solves so many issues. It's bigger because it's the Uberization of housing. We don't need the government. We need the government to get out of the way. It's faster. It takes 3 months to build a basement apartment. It's cheaper. $70,000 creates the unit. And now we're also building affordable housing. And it's easier. It takes 5 years or 10 years to start with a piece of dirt and to build an affordable housing building on it. We're really excited about this process. And if there's any home builders, so we initially wrote the book as sort of just a Saturday morning project for Rod and I about how do young people buy a house. And we think there's a platform here called the Selffunding House. We trademarked the name. We like it so much. To build a business to help developers get in the mindset of building this duplex, then marketing it, and then teaching the tenant how to become a landlord. What we found in interviewing home buyers was their greatest fear was becoming a landlord. And if you do this properly and professionally, the problems of being a landlord are greatly minimized, and that's what we train people on. We've got a number of webinars coming up. Rod, I'm just wrapping up now. We've got a number of webinars coming up. And that I think you might be interested in. We've got the session August 9th on why we think Alberta is probably the best apartment market in Canada. We've got a number of buildings now listed in Calgary and Edmonton that we'll be talking about on that session as well. But this is just a fundamental view of the province of Alberta and why we think it might be the best place in Canada to invest in. On September 14th, we've got our U.S. opportunities webinar. We're going to have specific deals that are available in the U.S., not listed deals, but that are available for either acquisition, joint venture, or trading that we think is going to be very interesting. We're going to do this on a monthly basis. It's not the theory of investing in the U.S. We're not talking about where, how, and so on. We're actually showing deals. We're going to have developers on. We're going to have brokers on talking about deals that are available that we think might be interesting to Canadian investors. We've run now, for this will be the third year running this apartment development, university apartment development masterclass. This is a series of, it's 11 sessions on new apartment construction. We've got about 10 people signed up for it, so on. It's going to be in the fall of this year. And a lot of developers are actually enrolling their staff and their children in the program. It's a online program, very detailed with specific examples. We've got a faculty of about 12 people teaching it. And if you're interested in apartment development yourself, or you're a developer pivoting to apartments, or you've got children, or you've got staff people that you'd like them to learn the fundamentals of new apartment construction. I don't think there's a course like this that exists in the world. You might want to look at it and sign some of your people up. Rod, anything else you have to do in terms of housework? Otherwise, I've got it wrapped up.
No, I think we're good, Derek. We'll just make sure everybody saves the date for October.
Yes, and we'll push out the topic then. Thanks very much for joining us, and we'll see you again soon. Thank you.